All right, time to rock and roll. Thanks, Nafis. I'm going to do my best. I got some interesting research I want to show today, and then we'll talk a little bit about careers in finance. One of my students from the Valuation Masterclass, I had a talk with him over the weekend. He's studying in Module 3. This particular student was an engineering background, has an engineering background, and they wanted to become an analyst in the stock market. And basically, we worked through how they could do that. But I'll come back to that in just a bit, and I'll talk a little bit more about that. But let's get it started. I just want to, make sure that you've got it. We are going live right now. Just going to type that in so you can see it. But now, so what we're going to talk about, I'm going to switch to my screen, and I'll do a screen share so you can see what we're going to talk about. I've got some interesting research to present today, but ultimately, obviously, we're talking about careers in finance. But what better way to think about careers in finance than to talk about some major finance issues that are going out? Now is the time to ask your question. I'm going to present some stuff, and I'm going to come back and look at questions. So put your question in there right now about careers in finance. All right, so today, what we're going to talk about, I'm going to talk about the death of price. Unfortunately, price is dead. And I'll tell you a little bit about my own story, and then I'll take some questions and answers, and then I'll show you, for those people that really want to build a competitive advantage in the area of valuation, I've got an offer for you. So one of the things that I've mentioned before, and I keep talking about, I'm very excited to have recently created this course. There's 36 lessons in it. It's about an 8-hour course, and it's called Finance Made Ridiculously Simple. And I've got a way for you to get this course for free. It's a $197 course, but I'll show you at the end. Now, what do I mean by the death of price? Well, what I'm calling the U.S. is the no loser policy. You see, losing sucks. It hurts. If you could avoid the pain of losing, would you? I would. Now, if you could avoid the pain today but suffer some consequences in the distant future, would you? Would you eat that sweet food, tasty, sugary carbohydrates, but know that you're going to get diabetes? That's what diabetes looks like right there. So you want some sweets? You want to tell your kids, oh, I'm going to give you a reward for being a good boy. I'm going to give you diabetes. I mean sweets. Well, a core principle of free markets is the operation of the pricing mechanism. So a free market, prices of goods and services are self-regulated by the open market and by consumers. The laws and forces of supply and demand are free from any intervention by a government or any other authority, and from all forms of economic privilege like monopolies and artificial scarcities. In this type of market, then prices get set. Is America free? No way. Look at this. It's ranked number 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. It's ranked 17th on the list of the degrees of freedom score. And this is done by the Heritage Foundation. Singapore and Hong Kong are known for being most free, New Zealand also. So I just stumbled upon this book, and this book actually also was translated into Thai, and it's probably in other languages. But basically, this author, Amy Marin, talks about to give up the bad habits that rob kids of mental strength. So she's trying to tell parents, these are 13 things that strong people don't do. You don't condone victim mentality. Number 8, shielding their kids from pain. We have to feel pain. If we don't feel pain, then we don't have good decision making. Taking shortcuts to avoid discomfort. Interesting book, interesting points. So most citizens believe the U.S. government can prevent or at least postpone pain. They don't want asset prices to go down. They don't want the stock market to go down. They don't want wages to go down. They don't want to have to pay a high interest rate for money. So and they want unlimited borrowing. Ultimately, these things together could prop the stock market up in the US. But let's take a look at this, the Fed zero rates to 5 years to feed through. Now, what do I mean by this? If you look at the Fed funds rate, which is the blue line, you'll see that in 2008, they brought it down to basically zero. And it sat for zero until 2014. They tried to raise it, and then they're starting to bring it down now. So what you can see is that it took about 6 years of a lag before the effective interest rates went down massively for companies. And now US companies, instead of paying 5.5% in interest, they're paying 4% in interest. So we've had a very, very long period of declining interest rates. Now, if you can borrow money, if a company can borrow money at 4%, that means that almost every project is profitable. So what is the result of this? Eventually, zero interest rates fed through, as we just saw, into the companies. And what happened? The blue line here is the interest rate, and you can see that it went down to about 4%, which is on the left-hand scale. And the asset turnover went down from 1 down to 0.7. Now, what does the asset turnover mean? It basically means the amount of revenue generated for every one in assets. So if you imagine two factories next to each other, they both have $100 million in assets. How much revenue they generate? If one generates 100 million, it's 1 times asset turnover. If one generates 200 million, it's 2 times. So we would prefer generally the 2 times. But what you can see from this is that companies are investing because they can get cheap money. And even though the assets have not grown that much and the borrowing hasn't been massive, what they're investing in is very low yielding assets. And this will have a long-term impact in the US. Now, this malinvestment means US companies expanded into poorly performing assets. So here's a chart that shows we're going from 15 up to 30. And that is the US companies with asset turnover less than or equal to 50. It just keeps rising. It's doubled, and it's gone up quite a bit over the last 15 years. Now here you can see the sectors that have had the biggest drops. The energy and materials are the masters of malinvestment. They have been pumping money into their industry and into their businesses and getting less and less revenue from it. Now, also, let's look at buybacks. Buybacks were one unintended consequence of zero interest rates. What you can see here is when interest rates went down to zero, we saw buybacks going up. So the US companies with buybacks greater than capital plus retained earnings. In other words, basically, these companies have negative equity because of their buybacks. And rising means rising risk ultimately. Now, I decided to look at a table here, and this table looks at these treasury shares. So let's just look at it here for a moment. The column that says retained earnings for IBM 163, that's their lifetime of retained earnings. But you can also see, and the capital is at 0.9. That's the paid in capital. So there was a small amount of paid in capital, a lot of retained earnings, but you can see that treasury shares from buybacks were massive. Ultimately, equity was at 20.8 relative to 152. And what you can also see is some companies like McDonald's and Home Depot actually have negative equity because of the buybacks. So this gives us some picture about what's happening with buybacks. Now, the other thing I just want to show you was the US gearing could be problematic if earnings stagnate and rates increase. Have you heard anybody saying that interest rates are going to rise? Nobody's saying that. And the bond markets are not saying that because the yields are very low. So they're not anticipating inflation, and therefore people are not getting paid for the anticipation of inflation. So again, we're looking at effective interest rate. That's the red line. It's down to 4. So we show that interest rates are very low. And what we can see here is the net debt to equity has been rising and times interest earned has been falling. So we've got trouble there. Now, I want to show one last thing that I think is interesting. This is when the Fed attempted to stamp out the free market pricing of risk in the high yield junk bond market. Now, what you can see is if you go back to 2008, this high yield spread, meaning the yield on junk bonds relative to government or short-term bonds or high quality bonds, what we can see is massive. And this spread between the 10-year bond and the federal funds rate basically is massive. And the result of that is that in 2008, they let the market price, but in 2020, this year, they didn't do it. And it hit a peak at about 8% or 9%, and then the Fed started buying bonds. And when they started buying bonds, they destroyed price. So if you have any questions about that, you'd like to see other charts or anything like that, just let me know. And I'm going to just skip right ahead into some Q&A, and then if you have any questions, make sure that you've put them into the chat and I'll be sure to answer them. So let's talk about some Q&A that I got. Someone asked me, how can we as analysts detect potential accounting fraud in advance? Well, first of all, the first most important thing about accounting fraud is you've got to go with your gut. If your gut feels like something's wrong, then investigate. So obviously there's many companies that are not doing fraud, but there are a small number that are or are sneaking around it. Now, there's lots of different tests that we can use, such as the amount of accounts receivable. We can look at the cash flow versus the net profit. But ultimately, in many cases, fraud can come as a surprise. There are some cases where the behavior of the management as well as the behavior of the minority or the majority shareholders or the board is getting questionable, and share price may be hit. But ultimately, the big frauds such as wire cards sometimes are hard to detect. Also, if you're on the buy side and you expect that sell side analysts are going to warn you, they probably won't. And the reason why is that even if they suspect it, they're afraid to put a sell recommendation on the stock and get blamed for wrongfully claiming that there was fraud. All right, next question. Being a great analyst requires the courage to be different from consensus and seeing things that others can't. How can one cultivate such values? Whew, tough question. Well, definitely, you've got to be, if you want to be successful, you got to be different from consensus. And now, you don't have to always be different from consensus. You don't have to be massively different from consensus. But it's enough of a difference that it can make a difference in the outperformance. Well, the first thing is you don't want to take a stance that's different from consensus without doing your research. Then you're just a person that takes the other side. You don't want that. You want to do your research. The second thing is that you don't want to make your conclusion about a particular stock until after you've done your research. And that's not easy because most people go into their research thinking this is a buy. But you don't want to do that, particularly if you're a CFA charter holder. We have a code of ethics, which basically tells us that we have to be objective and we have to be independent in our thinking. So in this case, basically, that's the second thing I would say. The third thing, one of the tips that I did is that pretty much all my life when I wrote research on companies, I never looked at my competitors' research. And the benefit of that is I never got a seed planted from my competitors, so it allowed me to come up with my own ideas. The last thing I would say about this is that in order to do this, you've got to stop. You've got to step away. You got to sit down somewhere and you got to try to think about this company. And you can see when you look at a company, all the common things. Now you got to get beyond that common. And that just takes time. That just takes time. All right. How can the Valuation Masterclass help me get a job in finance? All right. So I do have people. I have one of my students that I mentioned. He's an engineer. He wants to get a job in finance. So basically, in his case, we did a call because he's a Module 2 student. He gets a little bit of time of mine. And we did a call. And from that call, basically, I helped him think about the idea that, hey, the way to do this is to say, I've been working out in the field as an engineer. And therefore, I understand out in the field. The second thing I told him is in the Valuation Masterclass, I'm going to give him energy companies to value. And by looking at energy companies, he can walk into a broker or fund management company and say, I already have the models done for these energy companies. And I would say that those are two very significant things. The point is that once you become a Valuation Masterclass student, then I'll do my best to try to help you out. All right, let me just take a short break to see if we've got any questions. If you've got any questions, let me know. Any questions out there? All right. So let's continue on. And if you've got questions, make sure you put them in there. All right. So now we've gone through a couple of questions. Let's look at this idea of how to become a valuation expert. First, in the Valuation Masterclass, I created it so you can get practical experience in equity valuation. I created it so you can gain confidence and advance your career, and so that you can increase your efficiency and get ahead, and most importantly, become an expert and make an impact. Now, we've got 1,500 students from 31 different countries right now, and we want to keep growing that and keep expanding it. So you're happy to have you as part. Now, I call the Valuation Masterclass the boot camp for valuation. What do I mean? The Valuation Masterclass is the complete, proven, step-by-step course to guide you from novice to valuation expert. Now, you start your journey to become a valuation master in Module 1, where we focus on building a strong foundation of the basics. Later modules will bring you mastery. Now, what do I mean by practical experience? Well, by Module 5, you'll have valued 20 companies and reviewed another 10. That's real, practical experience. Also, these companies are from different sectors, countries, and situations, and you'll learn how to analyze companies and write reports like a professional analyst. What do I mean by confidence? Well, you'll gain confidence from your practical experience in the Valuation Masterclass, and others will feel confident when they see the depth of your valuation knowledge. The point is, you will become the valuation expert in your company. What do I mean by efficiency? Well, in the Valuation Masterclass, you'll learn to value companies using the value model. And it's my model, the highly efficient valuation framework that helped me become a #1 analyst. When you're more efficient, you're more competitive, and that's the challenge. Okay, what about impact? Now here you can see one of my students sent me this message on Facebook, and she talked about boosting confidence. Now, to become a certified valuation expert, it's hard. You've got 5 modules, you've got 200 hours of learning. That's why I call it the boot camp for valuation. Now, after passing Module 5, I'll do whatever I can to help you get your dream job. Why? Because if you pass Module 5, I know you now have what it takes. So if you're inspired to become a valuation expert like me, and I was totally inspired to do it, I've got a special offer for you today. So we've got a 25% discount on Module 1. Usually it's $200. Today it's $149. Also, I'm going to throw in 2 books. The first one is 9 Valuation Mistakes and How to Avoid Them. You'll receive it by PDF as soon as you place your order. And that's a $10 value. And then I've also added in my How to Start Building Your Wealth Investing in the Stock Market book in PDF form. You'll receive it right when you order. That's a $10 value. So what are we talking about? Now you'll see there's a coupon code right there. That's what we use. We're talking about Module 1, a value of $200. We're talking about 9 Valuation Mistakes is a value of $10. Build Your Wealth is a value of $10. So the total offer today is a value of $220, and you just pay $149. Now, there's more. I'm throwing in my newest course that I just finished, Finance Made Ridiculously Simple. This is an 8-hour course with everything you need to know about valuation, but you got to sign up today using the code I'm going to put into the group. Good news, I've taken away all the risk for you. You get a 30-day money-back guarantee. If you're not satisfied, I'll give you 100% of your money back. No questions asked, and that's a key. There won't be anybody, myself or others, saying, why do you want to get out of this class? It's our mission to make sure that you are satisfied. So now let's go back, and if we've got any questions, let's take it. Any questions out there? All right. So I want to thank you for attending, and I'm going to include the information here on the coupon code. So if you are interested in becoming a valuation expert, just click on that code. It will take you right there. If you got any questions, just let me know. You can leave them in the question comment area, and I'll see you on the